Swayam Prabha. Digital India. Educated India.
Hello learners, I welcome you back to the course of Introduction to FinTech. Today's video lecture is on the concept of digital lending. I am Dr. Aparna Samudra from the Department of Economics, RTM Nagpur University, Nagpur, and I will be explaining today the concept of digital lending. Then we'll understand that what is the difference between digital and the traditional lending. And we'll also understand the role FinTech plays in the digital lending space. Till now, our focus has been on the digital payments. The other aspect, very important aspect of financing is the availability of credit or the lending. Till very recently, it were the traditional banks or the traditional financial institutions which were at the forefront of giving this credit to the people. But with the evolution of FinTech, this scenario is changing now. And that is what we are going to discuss today. So let us first understand that what is digital lending. Digital lending, if we wish to define formally, it is the process of offering loans that are applied for, disbursed and managed through digital channels. So those loans which are all applied, disbursed and managed through digital channels are called as digital lending or digital credit. So it is not only that we are applying or we are getting disbursement through digital channels, we are also applying disbursal is through digital channels, and also the management of that loan or that lending is through the digital channels. Now, the lenders in this space use digitized data to inform credit decisions and build intelligent customer engagement. So, if we are saying that if we do not have to visit a physical bank branch or a brick and mortar financial institution, then how do they decide that what is the credit worthiness of the person who is asking for this loan? So, in this case, as we have just said, that the lenders use digitized data, many a times alternative data, to inform the credit decisions and build intelligent customer engagement. The financial service provider leverages this digital data to inform credit decisions and deliver customer-centric experience. Now, understand the components of digital lending. We have understood that it is a process of getting loan wherein the loan is applied digitally, the credit worthiness is decided digitally, the loan is disbursed digitally, and then it is also managed digitally so as to have the very efficient customer experience. Now, let us see what are the components of digital lending. The three components, or this definition if we divide, it can be said that there are three components of digital lending. One, it is using a digital channel. So, if you see here, the first is use of digital channels, then not only digital channel, but also digitized data, and then very important component is focus on consumer or customer experience and also its management. Now let us understand all the three in detail. The first component of digital lending, we have said, is the use of digital channels. Lenders use apps and USSD, that is unstructured supplementary service data, to connect with customers anytime, anywhere. This USSD data is the text-based data or SMS-based data, which is present in case we do not have a smartphone or if we are not using internet data, but still through text messages, this USSD data is used to connect with customers anytime, anywhere. So when we get SMSs from the banks or we get SMSs from the fintech lenders, they are using USSD data. Customers can apply for loans, get funds, check account information, and make payments without visiting any physical branch. So, lenders are using digital data to get connected to the customers or to the prospective customers using apps and USSD. Customers are also going to apply for loans, get funds or get this dispersal, check their account information, and make payments without visiting any physical branch. These channels, that is, we are talking about these digital channels, allow finance service provider or the financial service providers to collect valuable digital customer data, which is used to improve services and assess their creditworthiness. So now learners, you will appreciate that till now we were talking about payment mechanisms and there we were talking about PSPs, that is payment service providers. Now we are talking about lending, hence we are talking about FSP, that is financial service providers or finance service providers. So what is happening in the digital channels? Lenders are getting access to the customers or the prospective customers through digital channels. Customers are also applying for the loans through digital channels, and then these channels allow these financial service providers to collect that customers' data so that the services to the customers can be improved and also their credit worthiness, that is their ability to make the repayment or how much loans they should be given, can be assessed. The second element of this digital lending is the use of digitized data. Digital lenders use data from sources like bank statements, credit bureaus to analyze a client's ability and willingness to repay loans. So digital lenders are what they are doing is they are going to source the bank statements and the credit bureau reports of the lenders to assess the client's ability and of course the willingness to repay the loans. That is whether the clients have defaulted in the past or not, or how much loans are still pending on this particular client. That all is assessed, that is using digitized data. In this, algorithms analyze this data to predict the repayment behavior, replacing traditional in-person evaluations. So since the data is all digitized, this digitized data of that customer is fed into the system using specialized algorithms, using the data analytics or business analytics. It is predicted that what is the chance that this customer is going to repay back the loan properly in time, or what is the chance that the customer may make a default. So what happens is that in this situation, the data is all predicted using machines or using softwares, and this replaces the traditional in-person evaluation. As we have said, that digitized data, or in the previous as we saw, that the digital channels allow the customer data to be used, and digitized data, this customer digitized data is used to create better experiences, offering things like personalized messages and targeted promotions. That is using our digitized data. For example, if you have taken digital lending from any app at any particular point of time, and even if you have repaid it, but since they have your data, they may be making targeted promotions to you, or they may be sending personalized message to you based on that how you have performed, how you have used that loan earlier, or what has been your spending pattern. The third aspect of digital lending is the focus on the customer experience and customer management. Digital channels provide easy access to financial services. The process from application to approval is much faster, as we have just seen, that it is the algorithm which is making the, deciding that whether the customer will repay or it will not repay, or what is the credit worthiness. So it is removing the in-person, evaluation to machine evaluation, making the turnaround time faster. So application to approval is much faster. Therefore, customers are, their experience gets enhanced. Not only this, customers receive tailored communications and offers, personalization of offerings are there, and also responsible products and pricings are offers based on data analysis. That is, if someone has performed well in terms of their digital lending, they may be offered a lower rate of interest compared to the traditional banks, where the similar rate of interest is charged to each customer. So if I have a better spending habit, if I have repaid my loans on time, maybe I am going to get here a better deal compared to the traditional finance. So after understanding that what is digital lending, now let us have a comparison between traditional and digital lending on various aspects. The first aspect which we are going to compare is the application. As we all know, applications in a traditional banking scenario is in paper forms. Branch visit is a must. Whereas when we talk about digital lending, these applications for any kind of a loan or a credit or lending is made either through mobile apps or websites, and it is completely paperless. Now, coming to know your customer aspect, which is KYC, which is essential whenever we do any kind of a financial transaction. In traditional models, physical verification of your KYC documents like PAN, Aadhaar is required. Whereas in digital lending, it is electronic KYC verification or authentication through Aadhaar, PAN and video KYC as well. Now coming to the turnaround time or the approval time. In traditional scenario, it may take days to week, particularly if it is a business loan. They may take a longer time to decide whether a business has to be forwarded a loan or not. If, for example, a small businessman wants a loan and if it is taking weeks for him to get that loan processed and number of visits to the bank branch, it may cost him a loss of money and of course time. Whereas when we talk about digital lending, it takes minutes to hours because it is the technology which is at work and reducing the turnaround time. Now coming to the cost to lender, what happens in traditional and digital? Of course, cost to lender is high in traditional models because they have branches to maintain and they have a large number of staff to maintain. Whereas when we talk about digital, because it is all automated, digital infrastructure is there instead of physical infrastructure, the cost to lender is very low. Now, what happens to the credit assessment? For the traditional models, it is the bureau score. For example, in India, it is the CIBIL score, which is going to decide whether the loan has to be given, at what rate of interest it has to be given. So, if your CIBIL score is more than 750, you may be given a lower rate of interest. But in case your CIBIL score is not there, you are a first-time lender, then the banks may ask you for a collateral or a mortgage. But when we talk about a digital model, they are taking alternative data, they are taking our digital footprints, and they use AI to assess our credit worthiness, which predicts whether the person will pay a loan or what is the person's credit worthiness. Customer experience, of course, is a factor where traditional banks are now improving, but initially the customer experience faced a lot of bureaucratic hurdles and of course it was a little slow. Whereas in digital, it is fast, seamless and user-friendly. Now, after understanding that how digital models are very different in lending compared to the traditional lending, now we'll understand that what role the fintech startups are performing in this area. Now here, I am giving you a figure where we will be seeing that who are the conventional lenders, what are the limitations of these traditional lending, and then what role the fintech is performing. What are the conventional lenders? Can you think of any learners? Conventional lenders are banks, NBFCs, cooperatives and many a times informal lenders like loan sharks or the unorganized money lenders. So these are the conventional or the traditional lenders. When we take loans from these lenders, what are the limitations of this traditional lending? It requires, as we have seen earlier, it requires physical verification of the person and the documents, and also the costs are very high. Traditional lending also talks about either the credit history of the person or it will talk about taking a collateral because they do not want to risk their money. Here, risk of irrational credit and limited funding opportunities also there. But when it comes to fintech, it uses, instead of a credit history, it uses AI and alternative data footprints. It talks about data-driven underwriting to set interest rates. That is, depending on how I have used my funding earlier, it is deciding that what rate of interest I should be charged. It, of course, has user-friendly digital platforms, making the customer experience enhanced. And then it talks about customized credit assessment methods instead of, standardized credit assessment models. Now, this is one picture which talks about history of digital lending in India, which started in late 1990s by online banking. Then early 2000s, we saw peer-to-peer lending. Late 2000s, mobile lending apps, that is on mobile, the lending apps came. 2010 saw integration of AI and machine learning into digital lending. And 2020s, we are talking about embedded finance and personalized lending. Now, what are the reasons for the growth of digital lending in India? One is, of course, continued financial innovation, supported by the digital infrastructure created by the government, supported by the smartphone penetration and internet penetration. These fintechs are continuously innovating. They are finding that there is a gap in what the customers want and what is being offered by traditional finance. So there is a continuous financial innovation. Rise in the consumer's income, particularly the disposable income of the middle income class. The rise in the standard of living of people is letting people want better. Therefore, the demand for consumer lending is increasing because people want to upgrade their lifestyles. They know that they have the power to repay in form of the installments. So consumer demand is there, as well as the small and medium enterprises. The demand from these business for loans is also increasing. The digital lending factor growth is also because people see convenience in taking these digital loans. They also see that the speed of approval of these loans is way faster compared to the loans which they take from the traditional financial institutions. And then, of course, the competitive advantage which is due to the regulatory requirements. For example, when we talk about financial inclusion, when we talk about JAM Trinity, when we talk about the availability of UPI, NACH, they are all creating an environment which is very competitive, which is making firms design products which are fitting into the regulatory requirements. And of course, there is an increased interest in India's fintechs in terms of making funding to these fintechs. So the investor base is increasing. There are venture capitalists who are ready. There are private equity funds who are ready to invest in the fintech space in India. Now, let us understand that what is the digital lending process. Till now, we have understood that how digital lending, what digital lending is and how it is different from the traditional lending models. Now, let us understand that what is the process of this lending. This process of lending is divided in 5 steps. It starts with customer acquisition, that is, the digital lending firms acquire customers using, we have seen, their data which they have earlier, alternative data, or from the various other sources. Then once the customer applies for loans, that is demand driven again. Once the customer applies for loan, second step is approval and analytics. More accurate decisions are done, quicker turnaround time, and access to new customer segments. So customer is applying, approvals are done how? By using data analytics, and then at the third step, this loan is dispersed. Now this dispersal of loan is again instant. Not only that, repayments can be remote without accessing any physical branch, and audit trails, of course, audit trails are there to check whether the payments are being done on time or not, and it is at a very reduced cost. After this, the collection, the fourth step comes is of collection, where more efficient customer management is there by improving customer behavior. For example, by giving nudges, by telling them beforehand in time that there's so much EMI is due, so keep your bank account well funded. So by giving such nudges, by giving them certain positive motivation, the collections or the default of repayment is reduced. And then again, it is customer engagement. That is, it is not only that the process ends here. They take it further here by making customer feel very important, because they want to cross-sell their products. That is, instead, one loan you have taken, some other product they will like to add, which is called as customer engagement. So this is the digital lending process cycle, which starts from customer acquisition, where customer is making a loan request online, approving using analysis, disbursing and making repayments by the customer. Collections are made through positive nudges, and then customer engagements by improved customer experience, operational efficiencies, and this is done so that cross-selling opportunities to the customers are created, so that the customer retains back with my company. Now let us see what are the various modes of lending. The one mode of lending is the direct lending. As the name indicates, in direct lending model, the NBFCs or the fintech lend entirely from its own balance sheet. So if I as a customer, I'm taking a loan from a fintech lending app, and if this fintech lending app is following a digital lending, direct lending model, all the money which this lending app is going to give me, all the loan which this app is going to give me from will be its own balance sheet. So, therefore, in this case, the lender assumes the full ownership of the loan life cycle, including underwriting of the loan, dispersal of the loan, and collections from the person who has taken this loan. So, the lender is completely responsible at the all stages. Why? Because this loan is being completely given from the balance sheet of that NBFC or of that fintech. So, underwriting of the loan means that how much rate of interest will be charged, what will be the repayment schedule, what will be the down payment. So all that will be made through the particular fintech. For example, in India, Credit P, Lending Card, MobiKwik use this model of direct lending. Advantages of direct lending are that the lender has complete control over loan origination, risk assessment and collection. There is no other person or no other institution is involved into giving this loan. So this particular agency or this fintech has complete control over loan origination, risk assessment and collection. Because of this, there is a faster execution with fewer operational dependencies, because if only I am giving loan from my own pocket, the execution will be faster, decision making will be faster. Since I'm not going to share revenue with anyone, higher margins come to me, because I'm not going to share this interest which I'm going to earn with anyone. However, there are certain challenges. in terms of the credit risk will remain with the originator, because if 100% loan I am giving from my pocket, and if there is some loan default, then that credit risk remains with only me. I cannot share that risk with anyone else. Another challenge is that the growth of these lending apps may get stunted or they may get limited when the capital available for giving loans gets limited. So if my availability or if my boot is less, if my capacity to lend is less, my growth will automatically get limited. Also, because I am sharing the whole risk of this lending, it requires a robust risk management and compliance infrastructure, because I cannot rely on anyone else. I have to manage my own risks. The other model of digital lending is called as co-lending model. As the name indicates, in this model, two institutions are partnering with each other. So it refers to a structured partnership, and this partnership is governed by RBI. RBI's co-lending model, wherein banks or large non-banking financial companies collaborate with smaller NBFCs or fintechs. So as we saw the direct lending model, where either NBFC or a fintech is completely giving loan from its own balance sheet, in a co-lending model based on the guidelines which are given by RBI, a bank or a very big NBFC may tie up with smaller NBFCs or fintech to give a loan. So that is a structured partnership. In this model, loans originate jointly and the risk is also shared proportionately. Commonly, it is in the ratio of 80-20 or 90-10. Unlike the direct lending model, where the risk was the company could not share risk with anyone else because it was completely a direct lending model. In this, the how much loans are going to originate, they are also shared jointly, and the risk is also shared jointly. The ratio is generally 80-20 or 90-10. Advantage of this co-lending model is that it enables rapid scaling through capital leverage. We saw the disadvantage of direct lending, that there, if the balance sheet size becomes limited, the ability to give loans also gets limited. Hence, the growth of that fintech gets limited. But because we are talking about a joint ownership of the loans, then it leads to a rapid scaling because you can take the advantage of higher capital base. It also facilitates our broader outreach, especially to the underbanked segments, because if a fintech is tying up with a very big bank already has a customer base, they already have a brand name, it becomes easier to outreach. It also allows fintechs to focus on origination and technology, while the banks or the NBFC can handle the regulatory oversight. So the risk management can be handled by banks or the NBFCs, whereas how the loan will originate and what technology needs to be used can be focused on by the fintechs. So each of the partners will focus on their area, on the area of their expertise. But what are the challenges of co-lending? It requires a seamless system integration and reconciliation protocols, because two different institutions are coming together to give loan to one single person. It requires that the integration of the systems is very seamless, and also reconciliation protocols, that is when the loan gets winded up, that also becomes very seamless. Joint underwriting, because two institutions are jointly giving a loan in a certain proportion, joint undertakings and risk-sharing arrangements demand very strong alignment. That is, the management of both the institutions should be strongly aligned at the common cause. Otherwise, there are a lot of frictions may arise. Of course, it is subject to stricter compliances and regulatory scrutiny, because two different institutions managed by two different bodies are coming to picture to give loan to a single person. So, regulatory scrutiny is more to ensure that there is no money laundering happening. So this particular table is giving a gist of the comparison of direct lending and co-lending models in digital lending. So if we see, if we start with risk ownership, in direct lending, it is 100% by a lender, whereas in co-lending, it is shared between partners. With respect to capital, high capital requirement in direct lending, moderate in co-lending. Regulatory complexity is moderate in direct lending because only one institution is there. In co-lending, it becomes very high. When we talk about scalability potential, whether we can match up the demand increase, for direct lending, it is limited because the funds available are limited, whereas in co-lending, it becomes very high. Operational control is full in case of direct lending because only one institution is giving that loan. In co-lending, operational control is shared. Where it is ideal, which is the best situation in which model should be used, direct lending model is ideal for those NBFCs or those fintechs which are very capital rich. Whereas growth-focused fintechs and NBFCs generally adopt a co-lending model because each of them will then concentrate on their areas of expertise. So, what have we understood in this lecture? We have understood that digital lending is a process where right from origination of the loan till the disbursement and customer management is done digitally. Therefore, it offers speedy loan application and disbursement. It relies on digitized data for credit decisions. We have also understood the elements which are involved in the digital lending. And then, fintech plays a very vital role in modern lending. And the models of digital lending, we understood were direct lending models and co-lending models. Both of them have their own advantages and disadvantages, and each one of them may be adopted by the companies in different scenarios. So, I will stop here with digital lending here. In the next subsequent lecture, we will take further the digital lending models. Till then, thank you and happy learning.